Hey there, it's Alok here, and did you know that what's tax-free in India could cost you thousands in IRS penalties? That's right, your PPF and EPF accounts that save you taxes in India could be a ticking tax bomb in US if you don't report them correctly. I have discovered that 8 out of 10 US-based NRIs are completely unaware of strict reporting requirements for their Indian Provident Funds. This oversight has resulted into countless penalties, unnecessary stress, and thousands of dollars being paid to IRS that could have been easily avoided with proper knowledge. So whether you have been in US for decades or you have just recently moved, this video could literally save you thousands in penalties. Today, I am going to walk you through exactly what you need to know about reporting your PPF and EPF accounts to the IRS. So before we dive into the requirements of reporting, let's quickly understand what these accounts are for US tax purposes. Your PPF and your EPF are considered as foreign financial accounts by IRS. This means they fall under special reporting requirements that many tax professionals who aren't familiar with cross-border taxation might miss. And here's something crucial that many NRIs don't realize. Even though these accounts are tax-free in India, the interest earned on your PPF and EPF is generally taxable in the US. Yes, you heard that right. The tax benefits that you enjoy in India don't automatically get transferred to the US tax system. So when it comes to reporting your Indian Provident Funds to US authorities, there are two main forms that you need to be aware of. First, there's the FBAR or FinCEN Form 114. This form is required if the total of your foreign accounts exceed $10,000 at any point during the financial year. And yes, your PPF and EPF account count towards these thresholds. Second, there's Form 8938, also known as Statement of Specified Foreign Financial Assets. Now, this form is filed with your tax returns and the filing threshold are higher than the FBAR thresholds. So let me break down these thresholds for you. For single filers living in the US, you need to file Form 8938 if your foreign financial assets exceed $50,000 at the end of the year or $75,000 at any time during the year. For married couples filing jointly, these thresholds are $1 lakh at the time of the end of the year and $1,50,000 during the entire year. And remember, these thresholds include combined value of all your foreign financial assets, not just your provident funds. So now let me walk you through exactly how you report your PPF and EPF accounts on your US tax returns. The first step is to gather all your documentation. First, collect the statement showing the value of your provident fund accounts at the end of the tax year, as well as the maximum value during the entire year. For your EPF, this information is typically available on your EPF passbook or through the EPF member portal. You need your PPF statement also that you can get from your bank or post office wherever you maintain the accounts. Now, when it comes to reporting the interest on the returns, the interest earned on your PPF and EPF account needs to be reported as your income on your US tax returns on the Schedule B, Part 1 of the Form 1040. You must convert the interest amount from rupees to dollars using the appropriate exchange rates. The IRS generally accepts any reasonable method for currency conversion as long as you apply it consistently. Now, if your foreign accounts exceed $10,000, you will need to file the FBAR electronically through FinCEN's BSAE filing system. This form is separate from your tax returns. For each account, provide the financial institution's name, the account number, the maximum value during the year, and also the type of account. The FBAR deadline is April 15th with an automatic extension to October 15th also. If you meet the thresholds I mentioned earlier, you will also need to file a form called as 8938 with your tax returns, providing details of each assets, its values, income generated, and the acquisition date. Now let's talk specifically about some special considerations about your EPF account, because I have noticed that most of the people who have worked in India and then gone to US have their EPF accounts. The tax treatment of EPF distributions can be complex due to India-US DTAA tax treaty. Under certain interpretations, EPF distributions might be considered similar to Social Security payments, which could affect their taxability in the US. However, even if the distributions might be tax exempt, you will still need to report your account in the FBAR and Form 8938 if you meet the filing thresholds. So if you're planning to withdraw from your EPF account, I strongly recommend consulting a tax professional who specializes in India and US taxation. Now let's talk about something serious: the penalties for not reporting these accounts. Now the IRS takes foreign account reporting very seriously, and the penalties can be severe also. For failing to file an FBAR, the penalties can range from $10,000 per violation for non-willful violation and to the extent of almost $100,000, and in some cases also 50% of your balances. For Form 8938, failing might result into $10,000 to $50,000 worth of penalties, which depends on your IRS notification. But here's a good news: the IRS has actually streamlined the procedure for taxpayers who have non-willfully failed to report their foreign accounts. These procedures can help you become compliant while potentially reducing your penalties also. So before I wrap up, let me share some important updates that affects NRIs with Provident Funds account. Firstly, as of 1st October 2024, NRIs holding PPF accounts will anyway stop earning interest. Prior to this date, interest rates will align with the post office savings rate, which is somewhere around 2%. So to keep your PPF account active, you must make a minimum deposit of 500 rupees per financial year. And remember, PPF accounts cannot be extended beyond the original 15-year periods for NRIs and must be closed on maturity. Also, it's worth noting that PPF funds cannot be transferred abroad or converted to foreign currency also. When your account matures, the funds must be deposited in your NRO account. So, I personally feel that you can continue holding your EPF if you want, but at least stop your PPF account. And if you haven't done any reporting of these provident funds, don't just panic. Reach out to somebody who specializes in these cross-border transactions. Maybe somebody who is a CA and a CPA at the same time. Reach out to them and ask them to help you with this filing. Start gathering all this data because the FBAR deadline is 15th of April. Being compliant doesn't mean closing all your Indian accounts. It just means that you need to properly report them and pay taxes whenever applicable on this income. So if you find this information helpful, hit that subscribe button and join my exclusive NRI only WhatsApp community for more such updates from our side. I hope you like the video. Share it with your NRI friends, and I'll see you in the next. Thank you.